Good morning, everybody. Today we're going to go ahead and talk about Amazon. We'll be looking at the assets, liabilities, and equity, as well as some of the operational materials as well. So without further ado, I'd like us to get started. Okay, if we look at the assets, you can see in the bottom right that the assets have been increasing from 2015 to 2016 on everything. The interesting thing is if we look here at the total current assets and we look at the increase on that, we can see that there was an increase of about 10,000 between 2015 and 2016, and slightly more, but nothing too crazy, is 15,000 from 2016 to 2017. So we can come down and look at the total assets and see that there is an increase of almost 10,000 total assets from 2015 to 16, and then an almost $50,000 increase from 2016 to 2017. Now, if we look over here, we can see that the current assets are 22%. There is a 22% increase from 2015 to 2016, and a 24% increase from 2016 to 17. So that's just this part right here. But then this part right here shows that it's on par with the current assets, as in the increase from 2015 to 2016, but then the 2016 to 2017 showed a 36% increase. There could be a lot of reasons for that, but if we look, we can see that the PPE has gone up drastically, and also the goodwill has increased quite a bit. The other assets, I mean, they've almost doubled. I mean, everything here has gone up, well, drastically. So if we look at our total liabilities, there are a few things I would also like us to note. First of all is that the current liabilities, if you remember from the last slide, the assets increased by 22%, and then it was 22% here as well, then 24%, and then 36%. So those are just from the previous slide from the assets to show their increase. And we can see that the liabilities are staying within a relative range of the assets increasing. I mean, it's a 1% difference from 2015 to 16, on par for 16 to 17 for the current liabilities. And for the total liabilities, it's a 2% difference and a 2% difference. So there's nothing really too out of the ordinary with them kind of staying on track or staying parallel to each other. And it just shows that maybe they're trying to use a little more liabilities to increase their assets. So either borrowing from the bank or buying more stock or whatever on credit. So that could be one of the reasons for this increase, or for the drastic increase. Now, for the equity, I know it's a little hard to see, but there's relatively stable for stockholders' equity. It seems relatively stable here from 15 to 16. There was a 31% increase, and from 16 to 17, it was a 30% increase. It's just as the company got stronger and started making more, people started buying into it and wanted to invest more. One thing that I really liked is one of my professors actually said that the difference between assets, liabilities, and equity are, well, is relatively simple. So assets are what the company owes. Liabilities are what the company owes others. And then equity is others' claims to the company, essentially. So I always found that interesting because essentially these stockholders are owners in the company, so they do own a piece of the company. And we can just see that even then, or even here, there was an increase, increase, increase. And like I said, it was just mainly because they're starting to get a stronger position, or they're picking up steam and people started taking notice. Now, when we look at all of those, the assets, the liabilities, and equities, and we put them together, we can see a few things. First is that they are all increasing. So there's an increase, 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 increase. And like I said, there was a larger jump from 2016 to 17 than there was from 15 to 16. So we'd really have to look a little deeper to find out the exact reasons, but it seems like, at least now that Amazon is a well-known brand and a well-known name, that it could be just attributed to their strong market position and everyone just trying to get a piece of the action before they took off, which at this point in time, it's 2017, they've already taken off and they're already a relatively stable company. Now, for just for fun, I decided to go ahead and throw some ratios in here just to kind of compare the things. One of the reasons why I did 2015, 16, and 17 is so that I could get this part here, this net, or this return on assets. And essentially what you need for that is you need to be able to get an average, and 3 years is a pretty good average. That's why I'm able to get it there and not so much on these 2 years. So that's pretty much the main reason why there's nothing on those two. Now, the return on assets tells us a couple of things. One, a higher ROA indicates a more efficient way of using the assets, or the company is more efficient when using the assets. And then it also gives you an idea on how effective the company is in converting the money it invests into net income. So those are a couple of things. And then if we look at the return on equity, this measures how effectively management is using the company's assets to create profit. A good or bad ROE will depend on what's normal for the industry, so it may vary from company to company depending on the industry, and it's really hard to compare out of industry return on equity. So the other thing is this current and quick ratio. These are just some real simple calculations. These are actually known as the quote-unquote acid tests, but they tell us a couple of different things. The quick ratio and the current ratio are both indicators of a company's short-term liquidity position, and it measures the company's ability to meet the short-term obligations with its liquid assets. So what it's trying to tell us is if it has a current ratio of 1, then that means for every $1 of assets, they have $1 of liabilities. And so a 1 is essentially neutral or mediocre, and it helps us determine how well a company would be at paying off its current liabilities. The other thing I wanted to mention is the debt to equity. And the debt to equity ratio compares a company's total liabilities to its shareholders' equity. This can be used to evaluate how much leverage a company is using. Typically, a higher leverage ratio tends to indicate a company or stock with higher risk to shareholders. And then if we look down here at the bottom, we can see all of these operating ratios. Operating income, net operating profit after tax, operating assets, operating liabilities, net operating assets, and net working capital. Now, essentially, these all tell us different things, but the most interesting one, or the one I've noticed that people try to calculate or are used in multiple calculations, is this net operating profit after taxes. And it's commonly referred to as NOPAT. And for the calculations here, the tax rate in between this time from 2015 to 17 it varied. On the high end, it was 35%. On the low end, I think it was around like 20 something, 20-ish. So what I went ahead and did is I just used the higher end, which can kind of skew it, mostly just because that was my assumption. But if we look at the filings or some of the filings for the most recent tax year, we can see that a lot of the companies actually they may have or maybe put in the, let's say, 25th percent tax bracket, but because of their debt and other tax shelters or just the way that they have all of their assets structured, it could actually reduce their tax bracket. So it doesn't really look like they're paying that 25% because, well, in reality, they're making financial moves to not necessarily avoid, but to mitigate the tax that they are responsible for paying. And these are just some of the sources I used. A lot of them well, all three of them is just for the clip art. The calculations, I went ahead and just plugged them into an Excel spreadsheet. And also, all of the financial information was gathered from the 10K for Amazon. So if you have any questions, comments, concerns, just let me know and I will do what I can to get back and answer your questions. All right. Thank you.